Hello everyone, welcome to today's video. In my previous video, I spoke about how my equity portfolio has been doing, especially during the market crash. Almost all of the different parts of the portfolio like mutual fund, direct stocks, PMS portfolio, everything is down by almost 20%. But my overall portfolio is still doing fine. That is because I have diversified it well. In this video, I'll speak about the debt part of my portfolio, how it has been allocated, what is the current IRR that I'm getting. There have been certain delays as well, I'll speak about them also, and some other things about debt. Like there are a lot of misconceptions and fears that keep the interested investors away from debt. I myself took around 2-3 years to actually get invested in the debt market despite being very interested in it. Perhaps because there is lack of awareness, there is lack of information on the net. And lastly, why do I like debt? I see a lot of potential in it. Recently, I came across a fantastic podcast by Alt Investor where founders and CEOs from multiple bond investment platforms came together and discussed the pros and cons of bond and fixed income investments. It's a great video, 90 minutes long. I've tried to list my key takeaways from the video in this one. So this is how my overall portfolio distribution looks like. In equity, I have around 50%, in debt, I have around 40%, and in gold, I have 10%. Now in debt, this is how the allocation looks like. In FDs, I have around 40%, 30% in large bank like HDFC, SBI, etc. and 10% in high interest FDs like Shriram, Bajaj Finance and stable money. Recently, I made a video around stable money as well. Then around 25% of the debt allocation is in bonds. These are senior secured bonds. And I invest mostly via Grip because I like Grip as a platform a lot. But there are multiple platforms now where you can invest. There is Wind, there is fixed income, there is India Bonds, Golden Pie. You can choose wherever you are comfortable with. Then around 20% of the portfolio is in invoice discounting. 10% is in securitized invoice discounting. This includes secured by bank guarantees and secured by trade credit insurance. And 10% is with unsecured invoice discounting. And then around 15% of the debt allocation is with high risk and high returns kind of investments. These are mostly asset leasing with startups and some other experiments that I had been doing. Now talking about delays and the issues that I have faced in the overall portfolio, I have faced issues with P2P lending. I recently made a small video around that as well. There's a platform called India P2P and there have been multiple delays on that platform. But my overall allocation to P2P lending is very small because that segment has been in trouble since some time. The RBI has been changing its guidelines, making things stricter around P2P lending, and hence I was conservative while investing in P2P lending. Apart from this, I have also invested in Blue Smart. Now recently there has been a lot of bad news about Gensol, which is the parent company of Blue Smart. Till now, I haven't seen any delays, but the overall situation is worrisome and I am watching this, how this pans out. The overall IRR that I am getting of my overall portfolio is around 12.2%. Now coming to some of the misconceptions and fears that keep the interested investors away from debt and fixed income market. In last 4 or 5 months of this channel, I have received so many queries and interest from our audience and community members around fixed income, and most of the questions are around 3 points. Now these 3 points are of course delays and defaults. Second is liquidity, and last is the understanding of IRRs. I wish the bond investment platforms did a better job at talking about this and discussing the delays and defaults freely and how do they affect the overall portfolios of the customer. Instead, what I have noticed is that they kind of shy away and try not to discuss or speak about the delays and defaults, which kind of puts the investor also in the skeptical zone and hence they avoid investing. Now, taking some of the pointers from the podcast that I initially mentioned, there was a great point mentioned by someone that when the equity market or the stocks fall by 20% over a period of 1 or 2 weeks, the investors kind of accepted that this happens in the stock market and it's fine. But when similar things happen in bond market or the fixed income market and there are delays or defaults, they kind of behave that the entire capital or principal is wiped out, which is usually not the case. Even in the worst kind of defaults, I'm talking about bonds, 40-50% of the principal is usually recovered, and these events happen much rarely as compared to the stocks falling by 10 or 20% over a short period of time. For example, let us assume that I have 20 different bonds in my portfolio. Each bond has 5% allocated. Now, if everything goes well, my expected IRR is around 12%. But if one of the company defaults and I get just 50% of my principal back, even then the impact on my portfolio is around 1%. So my net CAGR after 5 years would be around 10.5 to 11%. Now, second part is the liquidity. The SEBI has been very active in last 3 or 4 years and has been kind of promoting the fixed income market. They are revisiting the regulations, making them more stringent and more investor friendly as well. And this is also helping the growing trade volume of fixed income instruments, especially bonds and SDIs. For example, on GRIP, almost 50% of the bonds and SDIs are sellable in 1 or 2 days, which is a great feature to have. Now, IRRs for fixed income work in a slightly different way in which we are used to visualize as compared to equity markets. I have seen a lot of investors falter and get confused while talking about IRRs. There are a lot of multiple resources where you can understand how IRRs work, especially for fixed income instruments. If you want me to make a video about this, please let me know in the comments. I'll be happy to explain everything. Which brings me to the next point on why I like debt and why I think that it has immense potential, at least in 2025 for the next 5 or 10 years. Now, my favorite feature for the debt is its reliability and predictability. If you look at Nifty returns over the last 5 or 10 years, you see that Nifty has given consistently 12 to 13%. This includes a huge amount of volatility. There have been so many times where investors have exited markets in 2 to 3 years with losses. This usually does not happen in fixed income market, and the returns are usually in the same band of 11 to 13%. The second part is that bonds are a very important part of the economy. We see stock markets news on every news channel, on every newspaper, and we think that the company economy is led by its stock market, but that is not so. Debt is equally important, if not more, and that itself is big enough reason to invest in it. You are investing in country's growth and hence get great returns out of it as well. A lot of investors usually don't realize, but even fixed deposits are a form of debt or fixed income. But their returns are usually very low because they are extremely safe. Now, when they are looking for riskier investments, they only end up in the stock market. And this is where I think that bonds and other fixed income instruments offer a great opportunity. They are high risk, but they do offer great returns as well, along with a great stability and reliability. And lastly, there is huge growth potential in the bond market. If you compare India's bond market with some of the more mature markets like US or Europe, you will see that the bond markets are usually much larger than the equity markets. Comparing that with the Indian markets, the bond market size currently is just 10 to 20% of the stock market, which clearly shows the growth potential in this market. There was one particular insight by Nikhil in this podcast that as of now, bonds offer much higher returns what they might be offering in next 3 to 5 years. So this is a great opportunity, a great time to invest in the fixed income market. And lastly, the disclaimer. All of these points are just to share my opinions and why do I like debt. Ultimately, each investor has their own unique situation, their own unique risk appetite. Just like every investor has a different pattern of investing in equity, large cap, mid cap, small cap. Similarly, you invest in different kind of debt instruments as per your understanding and comfort. I hope this video was helpful. If you wish to discuss more about personal finance, fixed income, equity markets, feel free to reach out. I'll be happy to discuss whatever you want. We also have a small community where investors share ideas and we try to learn from each other and avoid mistakes that other investors have done. That's it. Have a great day. Be healthy, be safe, and invest well.